Hey everybody, my name is Dr. Winter. I'm a tax professor and tax attorney, and in this video I'm going to be talking about the basics of Section 721, which relates to our formation of a partnership. So under Section 721A, the code says that no gain or loss shall be recognized by the partnership or any of its partners when what you're having is property exchanged for a partnership interest. This may sound familiar to you if you've already gone through the corporation videos, and more specifically Section 351, because there's a parallel Section 351 in a lot of different ways. Okay, so 721 partnership formation is similar to 351 corporation formation. And I have a visual that I created for you that shows the rule, requirement, basis, treatment, liabilities, and the examples. So if it's in the blue, for the rule and the basis treatment, that means they're basically the same as a corporation. The red is where there's going to be some differences between the two. So let's look at the differences between partnership 721 and corporation section 351. So when we're looking at the basic rule, they're the same. We are not recognizing gain or loss when we contribute property in exchange for ownership interest. Ownership interest measured neither a partnership interest, right, our interest in the partnership, or our stock that we receive as a shareholder if we're dealing with a corporation. Those are the same. All right, second, the requirements. Hey, with a partnership, it's easy. You just contribute property in exchange for your partnership interest. You don't have to worry about that other stuff that the corporation had to deal with. That 80% control requirement, that doesn't apply here. We don't worry about it. If we're trying to become a partner in a CPA in an accounting firm, we don't have to have 80% control. We could have 3% control. That's okay. That's okay for a Section 721 transaction. Third one, basis treatment. So we're dealing with a carryover basis on both of those, whether it's 721 or 351. Now, I deal with basis a little bit differently. I have a different video that's going to walk you through basis. The reason I did a separate video on this is when we deal with basis, we have two different types of basis. We're going to have inside basis and outside basis. So we want to be able to combine those and be able to understand, okay, what is our outside basis, what is our inside basis, and how do we calculate both of those? Liabilities. So if a partnership goes ahead and assumes a partner's liabilities, then what's going to happen is we're generally going to reduce the basis that our shareholder has, or that our partner has. We're going to reduce their basis proportionally. So let's say that they contributed something that is, they have $100,000 of property that they're contributing, but there's a $30,000 liability associated with it. What we're going to do is we're going to reduce their basis by that $30,000. And then what we're going to have to do is we're going to increase it by the portion in which they're still going to be liable. I do a separate video on this as well, so we're going to be able to see the liability portion computations, so we'll be able to get that down. But let's look at a couple examples for you before we end this video. Carlos contributes property worth $100,000 to a partnership in exchange for a 50% interest. Since no liabilities are assumed and no cash is received, Carlos does not recognize gain or loss on the contribution. There's no type of boot in here, right? So if Carlos contributed equipment worth $100,000 and Carlos's basis was $20,000, Carlos has a realized gain of $80,000, right? But none of that realized gain of $80,000 is actually going to be recognized because 721A says we don't recognize gain or loss on the contribution of property in exchange for a partnership interest. So none of our $80,000 would have been none of our $80,000 would have been recognized in that example. Let's look at the second example I wanted to provide. Dana contributes property worth $150,000 subject to a $40,000 mortgage. All right, so now we've got a mortgage associated with this. The partnership assumes a tax liability. Dana's basis in the partnership interest is reduced by the liability assumed, but no gain is recognized immediately under 721. So we reduced Dana's basis in it by $40,000. Now, if Dana's still going to have some liability associated with it because of their partnership interest, then we're going to increase Dana's After we decrease it by the $40,000, we're going to subsequently increase it by the partnership amount that Dana's still going to be liable for that mortgage. So if Dana was a 50% partner, what we would have done is we would have reduced her basis by $40,000, okay, because the partnership assumed it. However, if Dana's still responsible for half of it because she's a 50% partner, we need to then increase her basis by $20,000. So there will be a net $20,000 decrease, right? The $40,000 decrease plus the $20,000 that she's still liable for. So the difference between the 40 and the 20 is 20,000, still decreased by 20,000. All right, well, let's go ahead and end here. What I will do next is I'm going to start walking you through the different basis. So we're going to see inside and outside basis and how we compute those. Like I said, if these videos are helpful, please subscribe to my channel, as I'll have several other videos relating to partnerships and then corporations as well.